Hello and welcome to this week's Financial Friday. This week I am going to cover the difference between a loan approval and a loan pre-approval and a loan qualification. So many people use these terms interchangeably, and I want to clarify this because there actually is quite a big difference. So let's start with pre-qualification. This is often the most basic preliminary step that you would take when it comes to getting qualified for a mortgage. So they are going to discuss a couple things with you. They'll go through what your income is. And typically at the pre-qualification stage, they are simply asking, what is your income? What is your credit score? What is your debts? And based off of the information that you provide them is where they'll give you a number. This is the stage where generally most banks are not pulling your credit score. They are not taking a deep dive into any financial documents. Really, they're just going based off of what you say, and there's no confirmation. Now, this stage also does not come with that rate hold that I love to tell you about. That rate hold will get you the best rate in the next 4 to 5 months, depending on what bank you go with. And that rate hold is actually a pretty big deal, in my opinion, because if rates go up, you actually get the better rate. But if rates go down, you still get whatever the best rate is. Now let's talk the pre-approval. So I love me a good pre-approval. A good bank will have gone through the entire process with you. They should have all your financial documents. So that includes your proof of your down payment if you're using one. That includes your income documents, so the last 3 or 4 pay stubs. Typically, they'll be looking for your T4s if they need that to show overtime. Or if you're self-employed, they'll be looking through your tax returns, your last 2 or 3 tax returns. So there's a really big difference. In this stage, they're verifying everything, and generally they are pulling a credit report as well, and that's to make sure that your credit is where you say it is. If they have an inkling that you might not be approved based on the documents that you're providing, then typically they won't pull your credit until they feel like you're in a scenario where you could get approved. But in this scenario, it is so much more in depth, and it actually gives you firm information. And while a pre-approval is never 100%, that's the approval, it's something that gives you more solid information to go off of. So they will give you a more concrete pre-approval amount of what you could qualify for versus the pre-qualification, which will be kind of a general range, basically if they think that you could get approved or not based on the information that you're providing. So in my opinion, there's actually quite a big difference between the two. And generally when people come to me and say they've been pre-qualified, I ask them to go back to the bank and get pre-approved, because the difference that it makes our ability to negotiate is drastically changed when we have a pre-approval as opposed to a pre-qualification. So the reason that it matters is it makes a difference when we're looking at houses. It makes a huge difference when we're offering on houses, especially if perhaps there was more than one interested party. Then we are able to say, hey, we have already gone through these steps. We are pre-approved and ready to go. And based on the bank liking this house, it almost guarantees that you will be able to qualify for that financing. So that is it for today's Financial Friday. Join me next week. We're going to talk about condo fees and what they cover in our local market here. So thanks for tuning in, and I hope you have a great weekend. Bye.